Hello candidates and welcome to the Public Finance and Taxation Learning Session. Today we are still on the administration of income tax and tax procedures. We'll be today studying tax returns and assessments. Now under tax returns and assessments, we are going to cover 5 things. 1, self-assessment. 2, default assessment. 3, advanced assessment. And 4, amendment of assessments. 4 things. So here in Kenya, the assessment of taxes and the filing of tax returns are fundamental processes in tax administration system that is governed primarily by the Tax Procedures Act and the Income Tax Act. And these processes determine a taxpayer's liabilities and form the basis for tax collection. So the key types of assessments and related procedures include self-assessment, default assessment, advanced assessment, and amendment of assessment. Those are the key types of assessments and related procedures, candidates. And that's what will form the basis of our today's lesson, beginning with self-assessment. Self-assessment. And that is in line with Section 28 of the Tax Procedures Act. Now, Kenya operates largely on self-assessment system. That means that the responsibility lies with the taxpayer to determine if they have a tax obligation. You understand? Taxpayers assess themselves. That is what self-assessment means. Self-assessment means to assess yourself. Kenya largely operates on a self-assessment system, which is to say that the responsibility lies with the taxpayer to determine if they have a tax obligation, and also to calculate their taxable income based on the relevant tax laws, for example, the Income Tax Act. They furthermore compute the amount of tax payable for a specific reporting period. It could be financial year for income tax. Then the taxpayer also has a responsibility to file a tax return declaring computed tax liability to the KRA through the iTax portal. Do you understand? So that's what we mean by self-assessment. The responsibility lies with the taxpayer. And the process is very simple. Taxpayers assess the prescribed tax return forms like the income tax return, the VAT 3 return, etc. via the iTax system. They input their income and expenditure details and then apply relevant deductions and reliefs. And the system helps to calculate the tax due. And when a taxpayer submits a self-assessment return in the prescribed form, it is treated as if the commissioner has made an assessment of the amount of tax payable for that period. All right, for that given period. That is the meaning of self-assessment. Okay, that is section 28 of the Tax Procedures Act. The Tax Procedures Act, section 28. Number 2 is default assessment. Default assessment. Default assessment is an assessment made by the Commissioner of the Kenya Revenue Authority when a taxpayer fails to comply with the obligations to file a tax return for a reporting period as required by the tax law. Default assessment. This is section 29 of the Tax Procedures Act. Self-assessment is done by the taxpayer. Default assessment is done by the Commissioner of KRA. Now, and this occurs when a taxpayer who is required to file a return fails to do so by the due date, and the taxpayer, it could be also occur when a taxpayer files a return, but the commissioner is not satisfied with the return. So default assessment, is important to note, is done by the commissioner, done by the commissioner of Kenya Revenue Authority, and we cited 2 circumstances when that happens, because ideally we say that Kenya largely relies on self-assessment, operates largely on self-assessment. But there are times when the taxpayer may not do the self-assessment. So when a taxpayer who is required to file a return fails to do so by the date, then the commissioner of KRA may do the assessment, and that's what we are referring to, assessment. Or when the commissioner is not satisfied with the self-assessment that is done by the taxpayer, then the commissioner can carry out the default assessment. You understand? It occurs in the second circumstance when a taxpayer files a return, but the commissioner is not satisfied with the return. Though that can lead to an amendment after engagement. And how is that done? What is the process of default assessment? Now, based on any information available to the commissioner, e.g. from third parties like employers, banks, or past records, and to the best of their judgment, the commissioner will estimate the tax payable by the taxpayer and issue a default assessment. And that, of course, has implications. And the implication is that a default assessment often results in a higher tax liability than what the taxpayer might have calculated themselves, because it is based on estimates and may not factor in all the eligible deductions or reliefs. So it also attracts penalties for late filing and potentially for underpayment of tax. So the burden of proof to dispute a default assessment will then lie with the taxpayer. The burden of proof will lie with the taxpayer. So it may be, we're saying that those are the implications. It may lead to a higher tax liability because the commissioner may not factor in all the deductions or reliefs when carrying out a default assessment. Now, another type of assessment, number 3, is what we call advance assessment. This is section 30 of the Tax Procedures Act. Advance assessment. Now, what is an advance assessment? What is an advance assessment? An advance assessment is an assessment made by the commissioner in specific limited circumstances where there is a risk that the taxpayer may not be available or able to pay taxes in the future. So even before the issue tax period ends or the return filing date is due, then the commissioner can carry out this assessment. It is carried out when it is clear that the taxpayer may not be available to compute this tax in future. And this type of assessment is typically issued in cases such as when there is bankruptcy or winding up or liquidation proceedings have been instituted against a taxpayer, and so on. It may also happen when the commissioner has reason to believe that a taxpayer is about to leave Kenya permanently, or where a taxpayer has ceased or the commissioner believes they will cease carrying on business in Kenya. It can also happen upon the death of a taxpayer, and that is when assessment of tax due up to date of death. Okay, assessment of tax due up to the date of death. You understand? Advance, just from the word advance, tells you that this is assessment that is carried out before the due date or taxes are to be paid. An advance assessment is an assessment made by the commissioner in specific limited circumstances where there is a risk that the taxpayer may not be available or may not be able to do what? To pay taxes in future, even before the usual tax period ends or the return filing date is due. The commissioner may carry out this assessment. And I've given circumstances when this happens. I've said that this type of assessment is typically issued in case such as bankruptcy or winding up or liquidation proceedings have been instituted against a taxpayer, or when the commissioner has reasons to believe that a taxpayer is about to leave Kenya permanently, or where a taxpayer has ceased or the commissioner believes they will cease carrying on business in Kenya. You understand? So when that happens, then the commissioner makes the assessment based on information available and to the best of their judgment. And the purpose here is to secure potential tax revenue before the normal collection cycle. So that is an advance assessment. Advance assessment. Then we have amendment of assessment. Amendment of assessments. And this is section 31 of the Tax Procedures Act. Amendment of assessments. Amendment of assessment. Now, an amendment of assessment allows for previously issued assessment, whether self-assessment or default assessment or even advanced assessment, to be changed. This is amendment of assessments. Which assessments are these? It could be the amendment of the self-assessment or the amendment of default assessment or the amendment of advanced assessment. Are you getting it? It is an amendment of assessment. Okay? It allows for amendment of previously issued assessments to be changed, and that can be initiated by either the taxpayer or the commissioner. It is still an assessment. Okay? It is amendment of assessment. The assessments that were done previously can be amended. So when they are amended or changed, then we are referring to such assessments as amendment of assessments. Amendment of assessments. And this amendment can be initiated by the commissioner or by the taxpayer. You understand? Amendment. So let's look at amendment by commissioner. So it can be done by commissioner or by the taxpayer. By the taxpayer. Now, the commissioner may, within a specific period, generally 5 years from the date of the assessment was made or the return was due, whichever is later, the commissioner may amend an assessment if they are not satisfied with it, or if new information comes to light indicating that the initial assessment was incorrect. That is one. Now, number two, it could be in cases of fraud. In cases of fraud or gross or willful neglect or evasion, there is generally no time limit for the commissioner to amend an assessment. If it was just incorrect, there is a limit of 5 years. But if it is fraud, then there is no limit. If there is gross or willful neglect, or if there is evasion that happened, then there is generally no time limit for the commissioner to amend an assessment. The commissioner can amend it after 10 years, after 15 years, as long as information has come out indicating that the self-assessment that was carried out or default or advance was erroneous, then an assessment, an amendment can be carried out. Now, before issuing an amended assessment, the Kenya Revenue Authority typically engages with the taxpayer, often through an audit or investigation to discuss the findings. So an amendment of assessment can be initiated by the commissioner of KRA or by the taxpayer, or by the taxpayer. The taxpayer. Now, the amendment of the taxpayer can only happen with the self-assessment. A taxpayer who has submitted a self-assessment return may apply to the commissioner to amend that assessment. And this is usually done within a specified time frame. For example, 5 years from the date the return was submitted. And taxpayers may seek to amend a return to correct errors or claim previously unutilized deductions or reliefs, or just adjust for changes in circumstances. And then the commissioner must consider the taxpayer's application for amendment. So an amendment of assessment can be carried out by the commissioner or the taxpayer. As for the taxpayer can only seek amendment of an assessment that he or she did previously. A taxpayer who has submitted a self-assessment return may apply to the commissioner to amend that return. And it is done within a specific period of time. After the lapse of that time, then the taxpayer cannot apply for an amendment of a self-return. taxpayers may seek to amend return to correct errors or to claim previously unutilized deductions or unutilized reliefs. So those are some of the reasons why an amendment may be sought by a taxpayer. All right. So it's important for us to understand that there are four main. I've said that in Kenya, Kenya is largely relies on self-assessment, where taxpayers are required to determine if they have a tax obligation. Taxpayers are required to calculate their taxable income based on the relevant tax laws. They are required to compute the amount of tax payable for a specific reporting period. They are required to file a tax return declaring the computed tax liability to the KRA through the iTax portal. That's the meaning of self-assessment. And while self-assessment is the standard approach, the Kenya Revenue Authority has powers under the tax procedures to issue alternative assessments, like the default assessment, the advanced assessment. And that happens in specific situations, and also to amend any assessment to ensure the correct amount of tax is assessed and collected. And taxpayers have the right to object to assessments they disagree with, as long as they follow the procedures outlined in the Tax Procedures Act, which may lead to a review by the Commissioner or further appeal to the Tax Appeals Tribunal and even to the courts. So candidates, that's the end of our today's lesson, where we've studied tax returns and assessments. The self-assessment, default assessment, advanced assessment, and amended assessments. Thank you. God bless you. Bye-bye.